Fractional reserve banking. This is something that has been making the news recently as people are waking up to the fact that this one thing is responsible for much of the instability that we see in our economy today. Fractional reserve banking makes banks vulnerable to bank runs. If everybody tries to go get their money, well, you realize if you're not first in line, you might not actually be able to get your money because it's been loaned out. They only hold a fraction of the reserves. That's what it means. They've lent out everybody else's money. They don't have your money. And the instability, the fragility that fractional reserve banking causes is nothing new. This has been going on since the invention of fractional reserve banking. So why, might you ask, did it ever start? If it has been doomed to cause bank failures from the beginning, then who in their right mind would have ever signed up for it? Well, let's take a little trip back in time to when gold and silver coins circulated as money. So when people paid for something or accepted payment, an actual coin, metal, traded hands. Gold is absolutely fantastic for salability across time. That basically means it preserves its purchasing power because you can't fake gold. I mean, you can, but it's very difficult and you can find out if gold has been faked. It's very difficult to produce more of it, so the supply stays relatively stable over time and it doesn't rust or decay or erode, anything like that. And so gold from 2,000 years ago still exists in perfect form today. And so it keeps its purchasing power across time. And so it was a great tool for savings for people. But when the purchasing power doesn't really change, two things happen. Number one, that thing gets more valuable because most other things do increase in quantity. So when people find better ways to make more food and clothes and shelter and transportation and energy, you're creating more wealth. And so if all of that is denominated by the same fixed supply of money, that means those prices go down. This is good deflation that happened for most of human history. It became cheaper to get your hands on the things that you wanted and needed over time. But that also means that the money becomes more valuable, but it also means that they become more expensive to transport. So if you have to make a transaction across a large space, then that means you might have to pay for security for that gold to go across that space. And it's not very cost effective to do that. Also, it might get stolen. And if gold gets stolen, then, it's just like if Bitcoin gets stolen or if your wallet gets stolen or anything, it's like that thing is gone. Good luck trying to find the person that stole your thing and then getting it back. It's not like digital payments today that you can just reverse. This problem is called salability across space, meaning gold preserves your purchasing power, but it's expensive to use it to buy something that's really far away. This is fleshed out really well in Seyfedin Ammusah's book, The Fiat Standard. Fantastic book. I highly recommend it. I will link that in the description of this video. And so to solve this problem that's called salability across space, people started banking and getting paper receipts in order to use the paper receipts that were redeemable for gold, use those as money instead. Instead of transporting the gold for a purchase, you transact with the ownership of that gold and the gold never changes location. So what's the problem with this? Well, that costs money as well. You've got to pay somebody to build a building and build a vault and staff it and secure it and make sure it's all there and audit it and insure it. And that all costs money. And people for most of human history just haven't really enjoyed paying money to keep their money safe. They at least want to make some sort of return on it. And this is where fractional reserve banking came in. Because if I just store your gold for you and your gold is actually all there, then I have to charge you money to store your gold. This is a good rule of thumb for if you are buying gold or silver with a vaulting program. A good rule of thumb is that it actually costs you money, because if it costs you money, that means you're paying them to keep it for you. If it's free, you have to wonder, okay, well, how are they making money on my gold and silver then? And this is how fractional reserve banking was established. And this is why people were okay with it, because they recognized, hey, look, we're going to give you 100% of the gold. You're going to loan some of that out so that you can make money so that we don't have to pay you to charge it. You're only going to loan out a little bit just to cover the expenses, maybe a little bit more so that we can earn a little bit of a return on that as well. You share that interest with us, but most of the gold stays there. And so if a bunch of us come to get our gold at the same time, it's still there. And we just know that probably most of us won't come and get it all at the same time. And the reality is that this actually worked very well for a very long period of time. Yes, there were individual circumstances where you had over lending, where they lent out too much money, then there was inflation, a bank run, it collapsed, maybe they didn't have any of the reserves they said they did, and so you had isolated incidents like that, but for the most part that strengthened the rest of the system, because if you gave your gold to somebody and got swindled, you'd make sure that the next person you trust to be your banker actually keeps it. And so for every, just like airplane crashes, for every one failure, there's changes made and the incentives change in the system to make the entire system stronger. But as governments like to do, they tried to use centralization as a solution instead. Instead of allowing individual failure to strengthen the system, they tried to centralize it so that individual failure wouldn't happen, not realizing that this transfers all that risk to the entire system. Because you still have all of the problems from before, like the incentive for banks to overlend, to increase their profits, to take too much risk, to not have enough reserves. But now they can rely on the system to bail them out. So it actually causes what we call moral hazard. They get all the upside and none of the downside. And so since the creation of the Federal Reserve in 1913, the multiple depressions that we've had since then, the massive recessions that we've had since then, the systemic collapse and the risk of the entire economy failing because of banks participating in this model of fractional reserve banking, we know that the solution did not work. It does not work. And today, when anybody can go on and you can have an entire bank run in the course of an hour, everybody who banks there just opens up their app, transfers their money out to a different bank, and the bank can lose all deposits in the course of minutes. The risk to the system is way higher than it's ever been. You don't have to go stand in line and wait for your turn to get to the teller anymore like you used to. What does this mean for the future? Well, it means that more likely than not, the next phase of money will not be fractionally reserved. And there's really two paths that this could unfold on. Number one, this could unfold with government money not being fractionally reserved, or it could be free market money not being fractionally reserved. Either way, fractional reserve banking is a technology. It was invented for money that was backed by gold so that people wouldn't have to pay for gold storage. And so unless you have a commodity-backed money again, fractional reserve banking doesn't make the system stronger, it makes the system weaker. So we have two options here, government money and free market money. Essentially, this boils down to a CBDC or Bitcoin. Neither of these will work as a fractionally reserved banking system. So let's go down the CBDC road first. Step one, we get a couple big bank failures. Check, we already had that. Step two, you see more and more bank failures of the small regional banks, from things like the commercial real estate industry completely blowing up from their adjustable rate mortgages and their balloon payments coming due, them defaulting and these banks just going under. Both individuals and policymakers at that point will say, enough is enough. We don't want our deposits getting lent out. Yes, it's true that FDIC has guaranteed deposits up to $250,000 for each depositor, but FDIC has no money. And so that coverage, when it needs to take place, has to come from somewhere else. That can either be from taxpayers directly, that can either be from the Federal Reserve just printing that money, or it can be done through additional fees by all other banks to contribute to that pool. Either way, the people, the depositors, the nation overall is going to be paying through that, either through taxation or through less purchasing power of their dollars. The problem is, if banks want to stay in business because they are private businesses, they have to be able to make money in order to keep your money. And so they have to do something with it. If you deposit your money in that account and it just sits there, then the bank doesn't have a way to pay for the infrastructure to keep that money there. Banks are built on fractional reserve banking. What most people don't understand right now about banks is that banks are already, it is ledger money. So your bank has a ledger, which is just a list of all of the account numbers and how much money is in those accounts and what transactions led to that amount of money being in those accounts. So we do have a distributed ledger monetary system today. It's just a bunch of different isolated ledgers held at each bank. So the really easy solution for policymakers would to be just to say, hey, look, deposits have to be fully reserved, and the only way to be able to do that is not through for-profit banks. That's through a governmental organization that is funded by the Federal Reserve just printing money. Essentially, you fold all those ledgers into one ledger, and everybody just keeps their deposits at the Federal Reserve. And the Fed doesn't need to make money because they're the ones that print it. And so they can fund the infrastructure for keeping deposits because they print as much money as they need. They don't have to rehypothecate. They don't have to take your dollars and loan them out over and over and over again. They just say, here's a list, here's the dollars that are in your bank account, and they're there until you transfer them to another bank account. Now that comes with a whole host of other problems, and I've made dozens of videos about the terrifying future where a CBDC is the money. And so I won't go into that here. You can find those videos all over my channel. And I'll continue to say that a CBDC is the biggest risk that any modern economy faces today. If you like any freedom at all, a CBDC is your enemy. But you can see how many people would be very eager to have a CBDC come in and replace the money system that we have right now because it's an easy solution. Hey, my money can actually be there. They don't have to lend it out. I don't have to worry about a bank run, and I don't have to keep on funding all these bank collapses that happen after the banks made a ton of profits off of my money. And when I went to go get it, it wasn't there. And now I have to bail the system out either through fees or for taxes or through inflation. People will say, sign me up. Remove private banks, remove private profits for private banks, and fold that all into one simple list held at the Fed. I think it's very easy to see a future in which the banking crisis gets so much worse that people are eager to step into a CBDC. We have another option though, free market money, because a CBDC is not inevitable. Free market money, we're going to talk about Bitcoin because Bitcoin would not work as a fractionally reserved system either. Right now, we do not have a fixed supply of money with dollars. The money supply grows and it contracts. It expands and contracts based on lending. Loans are money getting loaned into existence. It is not taking from one person and giving to another. Loans actually create money, and loans have interest associated with them. And so as loans are made and repaid and made and repaid, and deposits go from one account to another, and interest is moving around in the system, the entire pool, the supply of money, is actually growing. And that's the only way you can actually have interest on money as a whole in a system. If the monetary supply is fixed, interest is a zero-sum game because the money supply doesn't expand and contract. So if you get $1 of interest paid to you, that's because somebody else is losing $1. Additionally, when the money supply is fixed, it cannot be arbitrarily expanded in order to bail out a failed fractionally reserved system. This is one of the reasons why FTX failed, because they had loans that they could not just print to cover, because you can't print Bitcoin. And so if you put your Bitcoin in an account that says they're going to pay you interest, and they take that Bitcoin and go do something else with it, and then you try and go get your Bitcoin back from them and it's not there, they shut down instantly because they just can't call somebody up and say, hey, we need you to create more Bitcoin for us so we can meet all these withdrawals. They actually have to have the Bitcoin there. And because the Bitcoin has to be there then to be able to meet those potentially fast and complete withdrawals, that means they can't be doing something with it that they could be making more money on. So the interest rate in a Bitcoin money system approaches zero. Not to mention the fact that if the money supply is fixed, that means natural deflation steps back in. And so a zero interest rate means, in nominal terms, zero interest rate means that the real return on that money is still positive because the purchasing power grows over time. So you don't even need a positive nominal interest rate on your deposits in order to keep up with inflation because we get deflation over time. The bottom line is that fractional reserve banking was an invention that worked well when people wanted to stop using physical gold as money and instead wanted to trade ownership of physical gold as money. It was a good agreement that allowed banks to create profit and that allowed people to increase their velocity and have easier, less friction with spending across space and across time. It allowed people to be able to spend less on the safety and the storage of their wealth. And when abused, it did cause economic pain for those involved. But it is not a system that works well today. It is not a system that works well when you are not anchored to a commodity-backed money. It is a system that only keeps the negatives, the fragility, the instability. And people are starting to realize that. And whether the future holds for us a central bank digital currency, a unified ledger of money instead of a distributed ledger with money that has to be loaned out in order to make profits for the very banks that are risking all of your wealth, or whether we move towards free market money and we see Bitcoin step in. Either way, fractional reserve banking is likely at its end. The only way I see this continuing and surviving into the future is if we go back to a monetary system where we have commodity-backed money again. So we very well may see this in other places around the world where we are seeing nations really push for new forms of money that are backed up by commodities. And in that case, fractional reserve banking will probably survive. Other than that, though, we may be witnessing the death of fractional reserve banking. Now, I do think it's very important to always look at both sides of the argument. And you know, I am one of the biggest critics of the Federal Reserve out there. And so that's why I decided to write a book called Why We Need the Fed. You can see here, I wrote this book, Why We Need the Fed. It is available on Amazon right now. And as an April Fool's joke for any of you who haven't seen this already, the book is entirely blank. So if you need a good gift to give somebody that is a huge Fed supporter and loves policymakers, what they're doing with interest rates and the inflation and causing all the instability in the system, I think this book is a perfect gift to give to somebody like that. Again, it's completely blank. It's available on Amazon. Why We Need the Fed by Joe Brown. Thank you so much for watching. Have a great day.